My name's Steve Boyce and I'm really pleased that you can join us for our investment webinar information session. Today we're going to give you a quarterly investment update and some understanding around how to get through this period in as good a shape as possible. As always, if you have any questions for our panellists, feel free to use the chat box and we'll make sure they get answered. The panel today is Michael Matthews and Catherine Creasy. Michael is a principal of our firm, a CFEX fiduciary, and heads up our Capital Partners Investment Committee. Catherine is also a principal, heads up our advice team, and sits on the Capital Partners board. So, Michael, I'm going to start with you today. Can you just give us an update on where investment markets are at the moment? So, how's everything tracking?
Thank you, Stephen, and good afternoon to our audience. I'm actually very pleased to be providing this update following a relatively strong quarter for investors. Our overview today will look mainly at the returns of the equity markets, both locally and internationally. And we'll have a look at the factors behind the returns and how it is that certain industries have done particularly well, especially against the backdrop of the COVID pandemic. And then we will have a look at the implications for investors, in particular the strategies that will serve them well during such periods of high uncertainty. So let's start with having a look at the major themes for the quarter. As was the case for the previous quarter, the major theme of the June quarter was, no surprise, COVID-19. And in contrast to the punishment investors took in the March quarter, the June quarter provided quite some relief. But for the real estate sector, we have seen market rallies that partially countered some of the steep falls we experienced in the March quarter. And the easing of the COVID-19 lockdowns, patchy potential signs of economic recovery, along with unprecedented government stimulus and central bank intervention, saw risk appetites return rapidly. The Australian dollar strengthened, providing a premium for the international shares part of the portfolio that is hedged to negate the impact of currency movements. Now, many were confused by the strength of the rallies, but if you were looking for an explanation, it is likely a combination of government and central bank stimulus, along with the reality that markets are known to overreact both negatively and positively. In addition, low rates on cash and bonds means some investors are forced to take additional risk and cling on to any shred of good economic news in order to hold stocks. On a yearly basis, a slightly different picture, with bonds and global equities the only two sectors with positive returns. Specifically, when we look into the individual components of the Australian market, we see the strong recovery in small and value stocks for the quarter. While year on year, the low and negative returns continue to reflect the economic uncertainty associated with COVID. Looking at the developed markets outside of Australia, as you would expect, we see a strong quarter with a level of relative weakness on an annual basis. Now, not all sectors have been adversely hit by COVID, with technology and healthcare businesses in particular doing very well, and energy and financials being the hardest hit. For those investors in the sustainability trusts, having a very low exposure to those energy stocks in particular, with high carbon emissions, has served them well, with better than market returns. And the strong returns in the technology and healthcare sectors is a similar picture for that of the global markets. You know, I don't think it is a surprise to anyone that, especially during the isolation lockdown period, those technology stocks that provide in-home services such as Netflix, Amazon, Zoom, and even locally Afterpay performed particularly well. And it's these style of businesses, these technology stocks, that have caused the significant dispersion, the significant gap in the returns between the growth stocks relative to the returns of the value stocks. Now, we are not of the view that the value premium is dead. We're not of the view that the premium from those companies whose share prices are lower relative to their book value of assets is dead. In fact, quite the opposite. Looking ahead, we very much maintain our view that investing in value businesses, especially those in traditional non-IT related sectors, represent very good value for investors. Now, we are certainly not calling the recent outperformance in the technology space a market bubble. Rather, given the extraordinary economic circumstances associated with COVID, we have seen the returns in those tech businesses underpin equity market results. And it's due to the nature of the tech businesses. They have a globally diversified customer base, they have very strong cash flows, and they have low HR costs relative to revenue. Value stocks, as I've mentioned, by definition, have lower share prices relative to their assets values, and therefore going forward do have higher expected returns, which is a very important thing for investors. The big unknown is just when will those higher expected returns be enjoyed?
Right. Thanks for that update, Michael. So as you've said, this is a really extraordinary time. And I know even just for myself personally, sometimes it can be really challenging, understanding and seeing kind of all the economic impacts of the COVID pandemic and how it's impacting all of us and the economy, and just trying to reconcile that against the relative strength we're seeing in the share market today. So really good insights there. I think it's also a really good reminder that share prices are generally forward-looking as well. So while they're not a perfect predictor of future economic activity, they're continually factoring in new and changing information on a real-time basis. So Catherine, to you now. So in these uncertain times, what's the advice that you're giving to your clients? So what are the things that people should be considering to ensure that they can actually get out of this in as best shape as possible?
Thanks, Stephen. Well, when things are uncertain, as they have been for the last sort of 6 months, that's when it's most important to be sticking to your plan. So keeping a check on your cash flow and avoiding purchases that you haven't budgeted for is really important. I guess, Michael touched on the fact that Afterpay has been a bit of a growth stock in the last 6 months, and that's one of the things that we want to avoid, making sure that you're not falling into that trap. There's also the natural inclination to just not look at the market. And that doesn't necessarily help you sleep well at night. So we think that for peace of mind, it's actually really important that you are speaking to us, to your capital partners advisor, and refreshing yourself on what your plan is so that we can reassure you and so that you can ask questions to get them off your mind. So a natural question that you might have at the moment is, how can I be confident that everything is okay? So what we talk to our clients about is that it's really about being able to hold your position and not have to sell shares or shares in companies while the market is down. That's why we've got some of your portfolio in fixed interest. So things like bonds that hold their capital value and that are very liquid, so they're easy to buy and sell. And when you need cash flow, that's where we'll fund it from if the market's down, so that we're not selling shares and locking in a loss. Now, as Michael mentioned, bonds have actually performed quite well over the last 12 months, and indeed, as expected, they've had a positive return. And the next question that you might have then is, well, tell me about the bond portfolios and what is the security of them, because that's where my secure store of wealth is. So I thought it might be worth just sort of passing to Michael to give us an update on the security of bond portfolios.
Thanks, Kat. Yeah, as you would imagine, the approach that we take in building portfolios is using the share and property investments as the main drivers of the returns. And they're the sectors of the portfolio where, if there were to be risk in terms of pricing risk and the variability of the prices on a day-by-day basis, it's in the shares and property, not in the bonds. And so for many, many years now, 1.5, almost 2 decades, we've only been recommending bonds that have a very, very high level of security, low level of risk, and the other, I suppose, low level of risk in terms of the underlying security of the bond issuer, and also a low level of risk in terms of the term to maturity of the bonds that we are recommending is very, very short. So again, I hope it's no surprise, and it should be quite reassuring for people to know that during the last 3 or 4 months in particular, we have gone back and reviewed and made sure that we were fully aware of what was going on in the bond portfolios, and pretty well making sure that ahead of time we knew that the integrity and the security and the high credit quality continued, so that investors could remain very comfortable, very assured that their money in those bonds is and continues to be safe. So we haven't seen any defaults, which is not surprising given the high credit quality of the bonds that we are recommending. The other thing to note is that the portfolios rather are particularly well diversified. So there are hundreds and hundreds of different bond issuers, being the Australian government, the US government, British government, major organisations such as BHP, the banks and similar businesses around the world. So we're not necessarily saying that the bonds are more secure than leaving your money in a bank account. However, we are absolutely comfortable that even in times of crises, that money is safe and doing what it's meant to do or meant to be, being a safe haven for funds. So as you said, Kat, you are not going to be in a position where you have to sell down shares and property assets to fund cash flow requirements.
Beautiful. Thanks for that, Michael. I know because I also sit on the investment committee. There's some really interesting conversations going on at the moment, which are ongoing conversations around what's actually happening beneath the bonnet. So it'd be really useful if you could just share with the audience just for a few minutes around what are some of the key topics, some of the things that are being discussed on the Capital Partners Investment Committee at the moment.
So there's 2 parts to it. One part is the regular items, and again, I hope people are not surprised, or rather should be pleased that we're doing these things. We review the integrity of the portfolios all the time, and that is that we need to make sure that investors' wealth is safe and is being managed well and properly long before there are any crises. So that when the crises do hit, we don't know when they will hit, we just know they will hit, that we therefore don't need to make any changes at that time. The other part, and I'll go into a little bit more detail, but the other part of it is to say, so what is different? What has changed? What has the impact of COVID been? Share prices in particular are generally representative of future cash flows. And when we look at some of the tech stocks, and it's probably no more than 1.5 to 2 dozen companies out of tens of thousands that are actually dragging the market up. We're looking at those and saying, so is it a bubble? Are those cash flows real? This is a really different time from the dot-com bubble in the 2000s. And I think dot-com, when we look back on it, it was the emergence of technology, and these businesses were still in their infancy, if you like, whereas now those tech companies are massive. I find it interesting how Tesla has, by size, by market capitalization in recent times, is now larger than Toyota. A sign of the times, and it's real. So what does the investment committee do? What are the key projects? Well, again, we make sure we undertake the due diligence on the underlying investments, the managers. We look at the cash flow. We look at the funds flow into each of the investments to make sure that they are healthy. And funds flow, being more money going in than out, means that the portfolio managers in particular have the capacity to take advantage of some of the lower pricing that has occurred, especially during sort of late Feb, early March, when the major correction first hit. So we looked at rebalancing, and rebalancing is one of those issues that seems really obvious at the time. However, when the emotions kick in and you say to someone, well, hang on, the portfolio's gone down by 5 to 10%, we want to be using some of the surplus cash in that portfolio to be buying back into these good shares and property investments at a lower price. Logically, it makes sense, but there's a lot of emotions and concerns running high. So we went back and tested that notion and improved our policy on rebalancing. We looked at the timing of new investors getting into the market, and while we don't have a crystal ball, we made sure that we reduced the risks of single point in time pricing, and that is reducing the risks of people putting their money into the market at one pricing point on one particular day. I've already mentioned the ongoing review and validation of the security of the bonds and the fixed interest component, which, again, not surprisingly, is in outstandingly good shape. So no surprises, and we're very pleased with that. We look at our suppliers. We look at the investment partners in Vanguard and Dimensional, and making sure that their processes are continuing to function, that they are by no means asleep at the wheel, and that they do have appropriate governance and potentially disaster recovery processes in place. We look at emerging markets. And the other thing, I suppose in closing, Stephen, because I could go on this for quite a bit, we're always looking at evidence, and that is what's working, irrespective of COVID, irrespective of economic conditions, irrespective of whether we're in a sort of a boom time or a time of concern. What is it that the evidence is showing us gives investors the highest chances, the highest probability of getting appropriate returns? So we're always looking for or researching to see if there are better ways or improved ways of investing. And the final thing is just a review of our forward-looking assumptions around interest rates, inflation, GDP growth, equity market growth, property market returns, and so on. And it's not that we have a crystal ball. It's more to say, what is it that's going on? Have things changed? Is anything different? When we look 10 years down the track on yield curves in particular, we're not seeing any material signs of inflation as a consequence of the economic stimulus we're seeing. So that does give us some comfort that we're not going to see a sort of an interest rate blowout or an inflation rate blowout. But we do want to make sure that if the economic impact of COVID is long lasting, 5 to 10 years sort of thing, that we want to make sure that our capital markets assumptions are an accurate reflection of what it is that is likely to happen, so that when people are planning and goal setting, that they can do it with a reasonable level of confidence.
That's great. Thanks for that, Michael. So big thank you to Michael and Catherine for their time today. I also just wanted to thank everyone for joining us. As always, if you're a client, if you've got any further questions, feel free to direct them to your advisor. If you're new to Capital Partners, feel free to check out our website and reach out to either Michael, Catherine, or myself if you want to chat. We're always really happy to help. So this video is going to be available on our website and YouTube channel for you to listen to again or to share with family and friends. Thanks for joining us.